One of the biggest mistakes you can do right now is to just focus on owning stocks that are cheap. That is a guaranteed way, in a lot of cases, to buy bad stocks, own bad companies, and either lose money or trail the market. Today, I'm going to respond to this article from Morningstar, 10 stocks to own during a recession, and I'm going to tell you why. On the surface, it looks great, but in reality, and history shows us, these are losing stocks, and we should avoid owning them in most cases. All right, Morningstar, respected firm. They've got a ton of research out there. They have a paid service. I actually subscribe to their service, so I do use it in some ways. But there is a negative side to just looking for cheap stocks to own during a recession. I don't want to just own stocks during a recession. I want to own stocks that I want to own for 10, 15, 20 years, not just during a recession. So that's problem number one. We are too focused in this article, in my opinion, on just owning stocks in a recession. That's going to create bad decision making. Here are the stocks they mention up front: Anheuser-Busch, Dominion Energy, Zimmer Biomet Holdings, Medtronic, Sanofi, Roche Holdings, Imperial Brands, GSK, British American Tobacco, and Bayer. Okay, Morningstar, head of economics, has pulled back its near-term GDP forecast to 1.6% in 2022, 1% in 2023, and then growth to rebound in 24. So basically, they're thinking we are in a very, low growth environment for the next few years for the whole economy, which means it's going to be tough for companies to grow as well, in their opinion. All right, here's the thing. Given all the talks of a recession, current or perhaps impending investors may be thinking about adding recession-resistant stocks to their portfolio. Listen, if we're doing this now, if we're doing this when the data shows that the recession has already started, that is the wrong time to be making these decisions. This article, these decisions, if you were going to make them and try to time the market and own stocks just for a recession, you should have done that a year or 2 years ago. Not now when the market's down somewhere between 20 and 30% if you look at the QQQ, and then we've got, growth stocks in general down 50 to 80% or something like that, right? That is not when you pivot towards a recessionary, buying into all these low growth cruddy companies, because guess what? Those companies tend to not recover, and they tend to not recover nearly as fast as companies that are actually capable of growing revenue. Okay, recession resistant stocks are companies whose products and services consumers will continue to purchase no matter the economic climate. These are all, low technology companies, cigarette companies, oil companies, whatever. Well, how are people going to stop buying technology products that they have essentially built their lives around during a recession, even if they're not spending on, extra stuff? They're going to still buy technology and spend time on places like Google, on Facebook properties, the cloud companies, all those cloud companies I own. Those are not going away in a recession, all right? That's another problem with this idea. All right, here's how they find these recession-proof stocks. They are in their defensive super sector. They can earn wide economic moat. Okay, a wide moat can be great. These stocks have low or medium Morningstar uncertainty ratings. Guess who these could be good for? If you are in retirement or need your money in a year or two, and in my opinion, I would not be investing fully in stocks if that was my case. It's not. I'm investing for the next 20 or 30 years, so I am happy being fully invested. These might be good for you to consider, but if myself taking this advice, I think this is ridiculous advice. These would be a ridiculous group of stocks for me to own if I wanted to grow wealth over time. All right, and look, this is basically what they went to. A very low price to their fair value, 0.50. I have a secret about having a very low PE or price to fair value. Sometimes there's a reason for it. All right, and again, Bayer, 0.58, GSK, 0.6, Zimmer, okay, got it. Anyways, that's how they're thinking about this. That's how they're approaching this. And this approach will get you in a lot of trouble as an investor. I would much rather just own an index or own SCHD. I just did a video on that dividend growth ETF a while ago. Here is the problem with these stocks, right? We are going to performance and we're going to max. So this maxes them out at 20 years, right? I want to see long-term performance of these stocks. Bayer was around 4% per year, lost to the S&P 500, which was 7.5% per year. BTI, okay, it beat the market over a 20-year period, 12.5% versus 7.5%. Great. One that beat the market out of two. Bud, Anheuser-Busch, 3% versus 12%. Okay, one that beat the market out of three. Dominion, 7.98% versus the SPY, 7.5. So 2 that beat the market out of 4. GSK, 2.2% versus the SPY, 7.5. 2 that beat the market out of 5. IMBBY, 3 that beat the market out of 6. Medtronic, 4.8 versus the S&P 500 of 8%. 3 that beat the market out of 7. RHHBY, 9.95. 4 that beat the market out of 8. SNY, 3.9%, 7.5%. 4 that beat the market out of 9. And then ZBH, 7.05, 7.49. 4 that beat the market out of 10. So only 40% of them are beating the market. You would have literally been better off just buying the S&P 500 over the last 20 years, essentially, which is how far a lot of these go back, and not worrying about owning each of these individual stocks. Why is this way, and why do I not want to own these stocks now? All right, it all comes down to this. Over the long term, what really dictates the returns of a stock, you do have to think about where you buy a stock at in terms of multiples. But over the long term, for the most part, what dictates stocks in their performance is the business's ability to grow. And the business's ability to grow earnings over time. And what you'll see is these are not growth companies. So black line right here, which is the price, you can see the price is actually down from 2013. So the stock has lost the market. And here's the problem. Average earnings growth rate under 3% for the past 10 years. That's bear. Now we're looking at BTI. 4% earnings growth over the past 10 years. Stock is actually down since 2012. Anheuser-Busch, stock down since 2012. Negative 0.5% earnings growth. Dominion, 3.35% earnings growth. Stock's essentially flat since 2011. GSK, 1.52% earnings growth rate. Stock essentially flat since 2011. IMBBY, 1.66%. Stock is down since 2011. So I should have done the last 10 years, not 20 years in that performance. But here we go. So Medtronic is actually up since 2011. 4% earnings growth rate. RHHBY, 4.5% earnings growth rate. Stock is up a little bit. SNY, 0.44. Stock is essentially flat or down over the last 10 years. ZBH, 4%. Okay, let's look at just one company right here. Major difference. Google, we're going the same time frame. 17% earnings per year. Look at the stock performance since 2012. Up 521%. Okay, these stocks, people were saying they were overpriced in 2011. They have shown the ability to continue to grow through recessions, through bad times. That's what great companies do. These software companies are able to be higher gross margin, more profitable, and grow quicker than any company in history because of the way technology works. Those are the types of companies I want to own with a approach that makes sense for my timeline, not a bunch of junky, recession-proof companies that aren't going to grow revenue or earnings for the next 10 years. Where's my return going to come from other than maybe a 10% or 15% return if the stock gets undervalued? Where is the long-term 500% performance going to come from? Stocks like Google, stocks like Apple, stocks like Microsoft, buying them at decent enough prices and holding them long enough, identifying great businesses and holding them long enough. Don't just own stocks based on the next year or a recession. Have a reason, an approach, and a long-term approach. That's my approach. Let me know what you think in the comments.